trend towards backing a whole bunch of small internet-related companies, mostly by super angels, and then valuations leapfrogging the traditional B and C rounds and going right to what would traditionally be a late-stage round. That's good. The other thing that's really good about this is the envy that it creates among people who've been out of the venture and startup scene. I'm talking about the capital providers. During the late bubble boom in 2000, 99, 2000, we got a whole new class of investors that came in. That was good in a lot of ways, bad in the sense that we got to overvalue companies. But the last 10 years, it's been very, very difficult to get your companies funded. And I think with the exception of a few of these big companies, I think that's going to change. And as much as we all talk about these companies now, there's nothing like that IPO to make everybody realize who's not in the tech-centric world how great these businesses are. Of course, it's also interesting to note that Groupon is based in Chicago, and you could argue that Groupon and Zynga and Facebook aren't even technology companies, right? I mean, what are they? They're on the internet, but how does that make you a technology company? Any more than I would say AOL or Yahoo are technology companies. So it's possible that we'll actually have more analysts who haven't been traditional technology analysts, maybe retail analysts, coming and following the companies. And that's good for everybody because you get a broader group of investors who'll come in. Last thing I wanted to touch on here is the fact that, yeah, the last 10 years have been tough for venture. I actually saw a really interesting stat, and I've been wondering about this. What have been the big drivers around why venture capital and technology companies have had a tougher time ahead, notwithstanding everything I've just said about these iconic ones? And here's an interesting number. In 1990s, actually in the 1980s, technology spending represented around 17% on average of S&P 500 profits. And in the 1990s, it was about 12 or 13%. And then in the last decade, it's been around 5%. And some of that is because, obviously, there was a lot of investment done in the 90s, but also some of it is because there's just less need to buy this stuff. Part of that is just because with innovations in technology, prices are cheaper. You can actually get stuff overseas and either outsourced or equipment that's much less expensive. But also there's just less spending. And so that has created a really tough time for the technology world. I hope that with this renewed interest in the consumer space, starting now and going forward, that you will see a lot more money now flowing into the sector, which helps everybody. And so I think that's it.
Hey, real quick, William, we thought at the beginning of the year we're going to see some big IPOs from like a Facebook, a LinkedIn. We didn't see any of those. What's going on there? Why didn't LinkedIn, which is making, I don't know, 400 million, 500 million revenue, where is a company like that? And aren't VCs trying to get exits from like a LinkedIn and these companies that they put money into 7, 8 years ago?
Yeah, I think two things happened. One, the IPO markets were good, but they weren't frothy, right? None of these companies needed to access public capital, right? Because there were so many late-stage investors. The most common one now is this DST, the one in Russia, who has been happy to put valuations of $1 billion, $2 billion, $5 billion on companies. And then you have a lot of investors in those companies saying, wow, our best days are ahead of us. And we want to make sure that the public markets really understand how big we can be. And therefore, the valuations we're going to get are going to be much more attractive. For instance, I think if Facebook had gone public 2 years ago, which it easily could have, even a year ago, it wouldn't command nearly the valuation it'll command now.
Which is like 30 billion, right? Something around 50 billion?
On shares post, they're trading at about 40 billion, $45 billion.
Wow.
So, who knows how big that could be, but could they have a $100 billion valuation? Maybe they could. Zynga, when it goes public, will probably have a 10 billion valuation. And Skype, they were acquired for about 2.2 billion. But I don't think it's unreasonable for them to have a $6-7 billion valuation. And of course, once you get those valuations, the good news is you have to then do something to justify those valuations. And a lot of times what that means is buying companies, which is why Google right now They had great success in maybe not in financial terms, but in other ways, acquiring YouTube.
They made 4 acquisitions just this week alone.
Yeah,
Did.
Not huge, but and now you have Amazon, of course, which is another very big market cap company. They've invested in Living Social, which is a Groupon competitor, not as big. But I think the other thing that's going to be really good for anyone who's in the technology world is that acquisitions now have got a new benchmark to be compared against. And for the last 10 years, it's been very much, hey, what is your financial picture look like? We'll apply some multiple against some comparable of a public company. And that's usually a loser deal for the investors. Now you've got people saying, wow, we don't know how big you could be. Groupon, you might be worth $6 billion. Twitter, you might be worth $10 billion. Who knows? But those ultimately lead to an inflation of the values for everybody else.
That's awesome. William Quigley.
Thanks, guys.